Certainly China's continuous presence in the headlines was always somewhat bearish. There didn't, and yet imports held up. Your thoughts and takeaways from the summer, Mike Muller, head of Vitol in Asia.
Christian, you've packed so much content into what you said. I'm going to run the risk of repeating some of it.
The editors will be in, don't worry.
I'll try and be additive here. I mean, obviously, It's been marred by adverse and extreme weather reports. We are seeing a more severe typhoon season here in the Western Pacific than in the Atlantic, although there was that very unusual hurricane that went into California, and the other one, of course, that went into the panhandle of Florida. We have seen $12 added to the price of Brent crude since the end of June until the end of August. So that's in 2 months, $12.50, and another nearly $2 on top of that in price action Friday. So we finished the season, as you call it, in the mid 70s, and we're now in the high 80s. And some would say that constitutes a breakout. You then look at reasons why the market's gone higher and reflect on what that means. I mean, very clearly, the removal from the market of the perceived excess supply by OPEC Plus, led, of course, by Saudi's voluntary cuts, whom some refer to as the lollipop, has taken oil off the market, and it's taken a few weeks or months even to see any data to underpin that, but there's definitely been a noticeable removal of inventory on the water, on the crude side of things. That's been coupled with a summer where we've seen, with hindsight perhaps should have made logical sense, which is reliability of the refining segment has been confirmed to be on more shaky ground perhaps than most predicted that to be. And given the absolutely stellar refiner margins last year, it's understandable that many refineries just kept running and postponed their maintenance from last year to this year. And in many cases, these refineries are 50, 60 years old, and you run the risk of unforeseen fatigue of instrumentation, of equipment, of hydraulics, and stuff that therefore causes refineries to be giving the market less uptime. The refineries, of course, are just the middlemen in the process, right? They decide the ebb and flow of whether a removal of crude oil from OPEC Plus results in a tight crude market or a tight product market. So these refinery problems I referred to resulted in a, surprisingly to most, tight market in that all-important product, which is distillates, which of course matters in a big way in things like Chinese construction sector. But I think it is fair to say that demand overall globally has worked hand in hand with the removal of crude oil supply to give us a fundamentally tighter market now. And I'm not offering an opinion here. I need to be awfully careful as we're on the cusp of APEC, and everyone's going to take away comments and lend a lot of weight to them. But if you just look at the facts in the market, and if you look at the front Brent spread, for example, so month 2 versus month 5 is sitting at about $2 a barrel for 3 months worth of spreads, 60, 70 cents a barrel a month. That normally tells you that there's a perceived risk premium or perceived tightness in the front end of the market because supply has been removed or demand is surprising to the upside. So Sean, maybe I'll stop short there. Well,
let me just come back on one of the points you made there, Mike, vis-a-vis China. The headlines through China from the second quarter through the summer were always somewhat bearish, struggling with the challenge of the real estate crisis, the service, the spending. But yet oil consumption, oil imports remained very robust through the second quarter. June came off a little bit over the summer, but ultimately consumption in China remains quite solid despite the headlines of negative macro numbers.
Yes, Sean. I mean, China really does sits front and center in terms of debates on demand, and it does divide opinion. And I'm going to go out of my way here not to offer a firm opinion and just to sort of observe on the various factors we're seeing. But there are several. I mean, the market continues to see headlines of the Chinese construction sector being a sick patient and requiring underpinning and support from government. The construction sector is responsible for a lot of energy demand, but it is not the only sector that consumes energy. We have indeed seen imports of crude, imports of coal, notably those two energy products, not too much else, but also petrochemical feedstocks, naphtha, and particularly LPG into China exceed expectations. But we have to remind ourselves that it's off a very, very low baseline.
And meanwhile, manufacturing has been month on month on a declining levels.
Yes, the Caixin index, or the PMI for China, has continued to come in at below 50, which signals a sector that is not buoyant and not expanding. Absolutely. However, the overall demand growth year on year China, I'll just repeat what I said before, is off a baseline comparing to a COVID year. 2022 was a COVID year. Price is also very important in China. China is quite price sensitive. This time a year ago, I just took a note here. We had a market price that was on the 2nd of September last year, $94 a barrel. So yes, China was not in peak demand mode because it had COVID issues, and the oil price was a lot higher. Then the next thing, of course, is that you've got a surge in the sectors in Chinese demand that are not linked to the construction sector. You've had a huge extra capacity being brought on in the petrochemical markets, which hasn't done much good for petrochemical margins, but it has seen China consume more than their fair share last year of LPG and naphtha this year. Chinese coal imports are absolutely high, much higher than last year around. And therefore, as an economy, we mustn't forget, people talk a lot about the Chinese stagnating demographic, one-child policy. Has urbanization peaked? Have they built all the highways they needed to build? But the Chinese economy, even in slow growth, is still growing. And if it's not growing in construction, it's growing in services, and it's growing in sectors like petrochemicals, where China is no longer importing advanced products made in neighboring countries, such as Korea, but making the stuff itself.
Mike, just picking up again on our earlier points and looking forward, as we sit on the eve of APEC, you referenced earlier, the headline in today's Financial Times over the weekend is about the China economic slowdown reverberating across Asia, with Korea manufacturing seeing, very low from a historical context, Vietnam, a lot of slowdown across the major manufacturing economies in Asia. Your thoughts on the outlook for the coming months, where that demand supply balance is going into the winter?
Yes, I think I hinted at it in petrochemicals. I mean, China is building capacity, which is making petrochemicals overcapacity a reality in many parts of Asia, and therefore calling into questions the economics of many of these plants running at viable levels, which even on maximum turndown, an olefins plant, an ethylene cracker tends to need to run at 60-70% to make on-spec products. So the concerns over China continue to dominate discussions here. I mean, that said, if you want to build a ship anywhere, including China, China is obviously taking a lot of shipbuilding orders off other more high-cost industrialized countries over the past few decades. The order books are full, right? So, I mean, just to underline some of what I was saying, the year-on-year oil demand on a year-to-date basis, projected forward to the rest of this year for 2023, has China consuming something like 1.2, 1.3 million barrels a day more oil than last year, of which about a third
is 24.
No, in 23 versus 22.
23,
right?
Okay.
Right,
But
so
again, as you said, last year was a COVID year, so it's from a low number.
I've given you the COVID number. The jet fuel is about a third of it.
Oh, jet fuel. Sorry. Okay.
100, right? More than half of the rest is petrochemicals, LPG and naphtha. But then there is a good slug of gasoline in there as well, for a country that's known to be selling electric vehicles pretty fast. And there was a price war of auto manufacturers for market share in the domestic automotive sector. Gasoline demand has gone up a lot in China this year versus last year. That's also a COVID factor, of course. But there's also been growth in diesel, which is the one that should be most hit by construction. So if you're up at 1.3 million barrels a day plus, as Christoph hinted, it would appear that a lot of the stock draw of oil on the water, high sulfur crude notably, has also gone into China. Is China replenishing, or is China building inventory? It obviously has a world significant strategic petroleum reserve these days. But what does China consider the normal baseline, and at what price do they hold inventory? And of course, the final thing to take into account, which just hit the headlines on Friday, was the market is still regulated in terms of quotas being granted by central government for exports. So we have to bear in mind that China last year, in the first 6-7 months of the year, hardly exported any diesel. It then got a directive to export a lot faster. And in Q4 and early Q1, China exported record amounts of diesel, 2 million tons a month. This completely weakened the global balance for diesel.
And they've just
Um,
approved
and
another third round of quotas for exporting of distillates, haven't they?
yeah,
Yeah.
I was one sentence away from saying that. So
Okay,
middle of the year went to what you consider normal balance levels, and the quotas they've issued are very much in line with expectations in the market, which is that regular levels to continue. So on a year-on-year basis, China has exported a lot more product into a market this year than last year, and despite that, the market has tightened. Now the amount of export quota that allows China to put diesel, jet fuel, and gasoline into the market for the balance of this year is at much lower levels than was the case for October, November, December last year, by a factor of maybe half. So China will not be the breadbasket of the Asian product supply-demand balance, as was the case last year. Breadbasket is a silly word, but a significant supply source in the way it was Q4 last year, at the very time of year when Asian demand grows for reasons of kerosene for heating in Japan, Korea, but also seasonal upswings. Yes.
I mean, as a China bull, Mike, do you feel challenged? Is the China weakness in this year, is there have we reached the floor of that? Could it get worse? I mean, this real estate crisis does seem to be, they're putting as many plasters on it as they can, but how long could you keep your finger in the dam? Whatever analogy you want. The Chinese seem to be unable to create stimulus. They can't pump money into the system because ultimately that could result in making the problem worse if you make credit easy, and cheaper and more available. So I'm just wondering your outlook for that sort of that China recovery. Is it, do you sense it could get worse before it gets better? Your thoughts on that sort of horizon, 4 months to the end of the year, for example?
It's very hard to offer opinion there, Sean. I mean, the Chinese government there was a wide array of views on what the government's priorities are going forward. This time last year, or coming into Q4, it was restoring growth. It seemed the trade balance was important. We're hearing that that oil price is important, and one assumes that China buys less as we move up to 90 or above $90 a barrel type levels. In terms of reinvigorating the ailing sector, that construction sector, cement, construction, timber, haulage, copper, the lot, right? Steel mills. It requires a stimulus package and a government intervention that's going to take much, much longer.
If it wasn't happening next week, i.e. APEC, you would probably want it to be happening in the sense of the biggest gathering of the oil trading universe in Singapore at this moment in time, trying to get a temperature on the scale of the China issue and the scale of the sort of ramifications for all of Asia. Your thoughts going into APEC week, what do you think will be the big talking points in the social circles?
It's probably the best attended APEC that we've seen in a long time. So it is busy. I've never seen as many line items of meetings on an agenda as I have on my plate this year. I think people will be talking a lot about the financials. I mean, a lot of the most brilliant minds in the industry, present company accepted, Christoph, are here, in fact, having weekend meetings and are discussing this very thing. I mean, open interest is important. You're going to have a lot of people here, but you have seen a inflow of spec money, or non-commercials, as the American exchanges refer to them, still historically at the lower end of the range, but it has been a very material inflow. And that was very much in response to the removal of OPEC plus production, and in particular by Saudi Arabia. But that now seems to have handed the baton over a little bit, thanks to some of the refinery dynamics I explained before, to a more fundamentally driven rally, which is manifesting itself in these backwardations, be it in crude, be it in refined products. I didn't talk about the numbers in distillate and gasoline, but they've been quite exceptional. There has not been an active hurricane season to mess with markets. Now, storms can be positive and negative for demand. But there does seem to be a feeling right now that there's a backwardation that's there for strong fundamental reasons. We didn't touch much on Russia, but all eyes this week will be on OPEC plus. It is the time of month when nominations are due, but OSP's official selling prices get released. And it's also the time of month when the monitoring committees get together and decide on whether to extend voluntary cuts or do any tweaks to the balances.
But all the
Price
reporting is
close
the
to-
expectation that the Saudis will announce that this week, that they will roll into October with the 1 million cut.
I think they have the option to. I'm not sure what's in the price. I think many people are expecting them to roll again. There are some people saying to me that the refinery maintenance period is not exempt in Russia. Russia has many refineries down also, so it might be quite easy for them to put forward a crude output cut, literally oil staying in the ground for the autumn month of September also, which could, on top of any Saudi extension, be perceived as an extra boost and has the potential to keep prices underpinned here in the high 80s. So difficult to say how much is in the price already, Sean.
Just closing thoughts there. Any other
The other
talking
thing
point you think?
it's very difficult to imagine how the price cap continues to remain in force with, I mean, differentials in Asia for Russian Pacific crudes, which don't always get the headlines. It's normally about Urals in the West. Are very.
I mean, there are increasing mutterings around that it has to get a lot more robust.
Yes, markets are efficient.